Welcome back everybody. Till now we discussed about incomes under section 28 and 41. Then we discussed expenditure from 30 to 37 sections. Then 38 also proportionate deduction we discussed. Disallowances under 40 and 43B we discussed. But now all these are perfectly fine. But what book should be maintained so that the income can be computed, the expenses can be deducted? That also we should discuss. And for this, I have come up with this video. Now, in this video, we'll discuss about section 43AA read with rule 6F, and then 43AB, because we also should not only maintain the books of accounts, but sometimes we also should get audit done, tax audit done, right? And two miscellaneous sections like 145A and 145B we are also going to discuss in this lecture itself. So excited? Let's start with the discussion. First section, 44AA. It talks about what? Maintenance of books of accounts. So what 44AA talks about? Maintenance of books of accounts. Now, think of that there are two different types of situations, like an assessee who is filing returns under presumptive taxation, like it may be 44AD, 44ADA, 44AE, 44BB, 44BBB, like this. Then for them rules are different, that we'll discuss under E and F, right? So if you are filing return under any of these sections, then E and F will be applicable to you, right? But for all other assessees, A, B, C, D will apply, right? This you should remember. Now, what is 44AD, what is 44ADA, 44AE, all that we'll discuss in the next video. Don't worry. But a brief idea I'll give this in this video itself. Okay. Now, so if you are covered under that sections, you file return under that sections, right? You want to compute income under that sections, then E and F will be applicable to you. But if you are computing income under the normal sections, which we discussed till now, then definitely A, B, C, D will apply. But here also two categories. Are you a specified professional or a non-specified professional? So you are obviously into business. So you are into business and are a specified professional. Then AB will be applicable. If you are into business but not a specified professional, then CD will be applicable to you. Like this, you should understand. Now, who are specified professional? At the end, I'll discuss. But whoever are giving specific service, like an actor, like a doctor, like a lawyer, like that, you should basically understand are specified professionals. Now, let us look at A and B together, right? A and B together I'll discuss. Now, question is very simple, right? What are your gross receipts or turnover? Is the simple question, right? Suppose you are doing business from years together, from maybe last 3 years, 5 years, whatever. So what is your turnover for the last 3 years? If suppose all the 3 years we checked, then is it crossing 1,50,000 every year? If the answer is yes, then please remember that you have to maintain books of accounts as per rule 6F. Then what they say? If suppose in any one of the last 3 years or all the last 3 years, your gross receipts were less than 1,50,000, then definitely you should maintain reasonable books, which will help the assessee or assessing officer to compute your income. That's it about A and B. Now let us recap with a practical example. Suppose for your exams, 24-25 is your previous year. Okay. Now, your previous year is 2024-25. Now, in 2024-25, which books you should maintain? To check, you will see last 3 years data, like 2023-24, 22-23, 21-22. Now you see gross receipts are 2 lakhs in 21-22, 3 lakhs in 22-23, 4 lakhs in 23-24. Oh, in all the 3 years, it crossed 1,50,000. Then in that case, A will be applicable and you have to maintain books of accounts mentioned under rule 6F. But suppose, sir, I'm not a person who is doing business from so many years. I recently started the business. I'm a new businessman. Okay. Then in the current year, is your business gross receipts going to cross 1,50,000? If the answer is yes, then maintain books of accounts as per rule 6F. Suppose come to B and try to understand. B also speaks about professional only, but it says in any one of the 3 preceding previous years, right, the turnover did not exceed 1,50,000. Or if you are a new business, you don't expect that your gross receipts will exceed 1,50,000 in the current previous year. Then just maintain such books which will help the assessing officer to compute your income. Right? A, B, clear to you. Now this is all about professional. Come to C and D now. It talks about other than specified professional. Suppose somebody is into manufacturing, somebody is into trading, then they obviously will fall under other than specified professional. Correct? Now, for them, what is the rule? Here, there is a categorization. General rule is your income should exceed 1,20,000 or your turnover should exceed 10 lakhs. What I said, income should exceed 1,20,000 or your turnover should exceed 10 lakhs. And that too, 3 years is here also written. Correct? Here also they wrote 3 years. But the point is, here they used the word any. What word is used? Any. Right? In AB, it was all the 3 years you should cross that 1,50,000 limit. But in C and D, in any one of the previous 3 years, if you cross that 1,20,000 income or 10 lakhs turnover, then you have to maintain reasonable books of accounts which will help the assessing officer to compute your income. Here the rules are little flexible. Are you able to understand? So what they said in C? See, you are a non-specified professional. In simple language, I am telling you are a trader or manufacturer, right? You are into such business. Then what they said? That your gross receipts, your income exceeds 1,20,000 or your turnover exceeds 10 lakhs when in any one of the 3 preceding previous years. If yes, maintain reasonable books of accounts so that the assessing officer can compute your income. But if the answer is no, the limit did not cross that 1,20,000 or 10 lakhs, right? 1,20,000 for income, 10 lakhs for turnover. It did not cross, sir. In all the 3 years, it was less than that. Okay. Then no need to maintain books of accounts itself. Right? This is what about C and D. But listen carefully. For individual and HUF, the limit of 1,20,000 is increased to 2,50,000 and for individual HUF, turnover of 10 lakhs is increased to 25 lakhs. So what did we understand? So suppose you are an individual HUF, your income doesn't exceed 2,50,000 and your turnover also don't exceed 25 lakhs in all the 3 years. Then no need to maintain books of accounts. But if any one of the two, income or turnover, cross in any of the 3 years more than that limit, then you have to maintain reasonable books which can help the assessing officer to compute your income. But suppose you are a new businessman, you don't have so much history of 2 3 years or 4 years, then what are you expecting? Will it cross or not? If the answer is yes, it will cross the limits. Then you are supposed to maintain the books of account, right? Which will help the assessing officer to compute your income. If you feel the limit will not be crossed, then no need to maintain books of accounts. That's it. D says no need to maintain books of accounts. Correct? Like this, you are supposed to understand the topic. Okay? So C and D talks about other than specified professional. Right? For individual, the income limit is 2,50,000. Individual HUF, the income limit is 2,50,000. For other assessees like company, cooperative society, partnership firm, 1,20,000. Whereas turnover limit for individual HUF is 2,50,000 and oh sorry, am I right? Wrong? Okay, let me recap for you. Right, what I said, income limit for individual HUF how much? 2,50,000. Turnover limit 25 lakh. Right. Similarly, for other assessees, income limit is 1,20,000 and turnover limit is 10 lakhs. This difference you should be able to remember. And if they cross the limits in any of the 3 years, then reasonable books so that the assessing officer can compute your income. And if you don't cross the limits, any of the two limits in all the 3 years, then no need to maintain books of accounts. That's it for C and D. Let's come to E now. What it says? E says 44AE, 44BB, 44BBB. Right? Or shall we also include this section called as 44ADA also, right? Here also, and you also take 44AD also, no problem. If there are certain limits under these sections, whether it is 44AD subsection 4, whether it is 44AE, 44ABB, 44BBB, 44ADA, for all this, E and F, anyhow, answer is same, correct? So what they say, if that limits given there are crossed, then definitely you are supposed to maintain reasonable books of accounts so that the assessing officer can compute your income. Are you able to understand? Right? Now, what is special about 44AE, BB and BBB? Right? They simply say that you have to maintain the books of accounts if you want to showcase that your income is exceeding particular limits. 44AD simply says that your income is 3 crores. Your turnover is less than 3 crores. And you are saying, no, my income is less than the given percentage. Then in that case, maintain the books of accounts. Okay. If you this presumptive sections show that your income is a specified percentage. Your income is specified amount. If you just want to show that income and file the return, then income tax has no problem at all. But if you want to say that no, my income is even less than that, then the assessing officer should be able to compute your income. For that, the books are required to be maintained. Like that, you should remember. E and F is simple. Now, let me ask you a question. What is specified professional? I already said to you, you remember, right? Legal professionals like lawyers, doctors, correct? Oh, lawyers. Medical professionals like doctors, right? Architectural professionals, maybe who are into construction, right? Film artists, accountants. As of now, only chartered accountants are covered, right? Like that, you should be able to understand that this is specified professionals list. So for professionals, specified professionals, A, B will apply. For other businesses, C, D will apply. But for presumptive taxation, E, F will apply. Like 44AD, ADA, AE, BB, BBB, right? Then E, F will apply. That's what we discussed. Now come to Rule 6F, books of accounts. Which books should be maintained as per Rule 6F? Very simple. What you study in your 11th class first thing in accounts? Journal, correct? Same should be maintained. Then what you study? Ledger, correct? That you have to maintain. What else? Then you study cash book, correct? So journal, ledger, cash book should be maintained. Okay? These three are compulsory under Rule 6F. Now what else? Then I'll ask you a question. Suppose you have a shop. You are selling the goods. You will give a bill to your customer, yes or no? Right? So suppose you have a bill book, right? Original is there. Under that carbon you keep, and whatever you write in the original bill is printed as carbon copy after under that, right? In the next page or the page beneath it, correct? So if you are giving the payment slip to your customer, that means you received the money from your customer. Then the carbon copy, original you will give it to customer, correct? The carbon copy you should maintain, right? When you should maintain? If the amount you received is more 25 rupees or more. How much? Amount you received is 25 rupees or more. So when you receive 25 rupees or more from your customer, maintain the carbon copy. Now, is this relevant? The answer is yes and no both. Because in the digital world, the era of SAP, Oracle and all that, as of now, businesses are moving towards it. But then think about small businesses, right? So if you think about small businesses, they still maintain cash bills only. Cash or records on a paper only. For them, these rules are still relevant. So what you remember? So if on original bill you wrote this is what customer paid to you and you received, that carbon copy is created for it. If the amount exceeds 25 rupees or exact 25 rupees, maintain the copy. Right? Next point is, suppose you went to a shop, you purchased something for your company, your business, then is the payment more than 50 rupees or exact 50 rupees? If yes, then maintain that original copy which that seller will give to you. Right? Maintain that original copies with you. But when? If it is 50 rupees or more. The job is done. Now shall we go to the next part? Suppose you are a medical professionals. Then patients will come to you. So you have to maintain the daily case register. So daily, how many cases, how many patients you have handled, that case register should be maintained by the doctors or the hospital, correct? And finally, if suppose they maintain medicines, right? They have an inventory of medicines. Then whatever drugs, medicine, right? Consumable accessories, which are actually used by the doctors or the hospitals should be maintained. Now, why they used the word drugs and medicines? You all understood. But what is consumable accessories? Suppose example, a stunt is there fitted into the heart, right? Or suppose there is a fracture in the legs, right? So iron rod has to be put in for some time so that the body can support. So like that, some accessories are used. So that's why it should be used. Now you may say consumable accessories. They are consumed for treating the patient, correct? Consumption doesn't mean that going to a pani puri bandi and eating something, right? Consumption can be for treatment also. So you have to maintain that also, right? But suppose how much time you should maintain it? The answer is you should maintain all these records for up to 6 years. Now you may ask, sir, 6 years from when? From the end of the assessment year. So suppose for your exam 24-25 is your previous year, 25-26 is your assessment year. So from the end of 26, that means from 31st March 2026, from that date, after that date, 6 years you should maintain. That means you should obviously maintain the books of accounts till the end of assessment year, but also plus 6 years, like that. After that, income tax department don't have the right to question. That's why you did not maintain. But up to that period, if you are not there having the records, you are not ready to show the books of accounts to the income tax officer, then you have to pay a flat penalty under section 271A. How much? 25,000 rupees. Right? So the penalty up to 25,000 will be imposed. This way, you should remember section 44AA. Now, shall we go to tax audit? Accounts we understood, right? Who should maintain? What should be maintained? Correct? I answered this or not? Up to what time it should be maintained? And what type of books should be maintained? Right? And if you don't maintain, what will happen? Right? This type of questions should be asked and you should remember. Right? Right. Who should maintain what took more time? Correct? Like this, you should remember. Let's come to tax audit, section 44AB. Now, when I asked you questions, you got the answers in your mind, correct? If yes, then you are in the right direction. If no, go back again, listen to the lecture, or at least read your notes copy and remember, try to remember. And during the lectures itself, you should be able to remember everything. That should be your constant effort, right? After the lecture, you will try to remember. That's the wrong mindset. The right mindset is I'll remember the concepts while I am attending the lectures itself. Lectures are not just to listen. Lectures are not just to remember, just to understand, but to remember as well. So you have to try to do all the three things during the lecture period itself. What are the three things I said? Learn, understand, and remember. Okay? Chal. And also, when we solve the problems, develop the capacity to reproduce in the way the examiner expects. Okay, let's continue with the next one. Now, let's continue with tax audit section 44AB. What it talks about. Let's think about a businessman. What he has to do? Is he required to get tax audit done? The answer is lying in a condition. For the businessman, his turnover exceeds 1 crore or not. If turnover is less than 1 crore, no need to no need to do tax audit, right? If turnover exceeds 1 crore, then tax audit should be done. Now, when we study this 44AA, maintenance of books of accounts, 44AB, tax audit, both are completely independent of each other, right? Books of accounts should be maintained if you satisfy very minimum conditions, minimum turnover, minimum income, correct? But tax audit should be done after you achieve certain high level turnover. What is it? If your turnover is exceeding 1 crore, then do the tax audit. If less than that, don't do. Not required to do. But suppose if your cash receipts and cash payments are less than 5% or only up to 5%. Cash receipts throughout the previous year, cash payments throughout the previous year doesn't exceed 5%. Cash receipts and cash payments doesn't exceed 5%. Then what to do? In that case, please remember, if cash receipts and cash payments doesn't exceed 5%, then what to do? Then you have to see this 1 crore limit is increased to 10 crores. What they said, 1 crore limit is exceeded or increased to 10 crores. That means if if it is less than 10 crores, turnover less than 10 crores, no need to do tax audit. Turnover 10 crores or more, then do tax audit. Like this, you should remember the topic. Are you clear? Very good. Now shall we go to the next story? The next story says, Are, come on, concentrate and try to understand what I said. Right? I simply said that, देखो, first assessee, business assessee we discussed. What we said, generally his turnover exceeds 1 crore, then he has to 1 crore or more, he has to do tax audit. Less than 1 crore, no need to do tax audit. Second point, what I said, if cash receipts, cash payment, both doesn't exceed 5% of the total receipts or total payments. In that case, come on. Then the limit is not 1 crore but 10 crore. Less than 10 crore turnover, no need to do tax audit. More 10 crores or more, then definitely do tax audit. Right? Come to the third point. But there are assessees who are covered under section 44AD. Now for them, the limit is 3 crores. Right? If your turnover is up to 3 crores, you are covered under 44AD. Okay. And as a percentage of your turnover, your income is determined. That we'll discuss in the next lecture. Now you are saying that no, my income is even less than the percentage given under Income Tax Act. If you say like this, income tax says no problem. Then do the tax audit also. So they already said maintain reasonable books of accounts so that the assessing officer can compute the income. Right? That they said in E and F now. Similarly, here they are saying that also do the tax audit. Okay, that's it. So 3 points we covered till now, right? First condition is cash receipts, cash payment doesn't exceed 5% of the total. Then please check 10 crores limit. More than 10 crores or exact 10 crores, do tax audit. Less than that, don't do tax audit. Leave these people, right? You are not satisfying that 5% cash rule. Then more 1 crore or more, do tax audit. Less than 1 crore, don't do tax audit. But there is another type of assessees who file return under 44AD. For them, if they challenge the income as per the percentage given under 44AD section is more than the actual ones, then maintain books of accounts under 44A so that the assessing officer can compute income and also do tax audit under 44AB. Like this, if you remember, that's it. Now let's come to professional. What they talk about professional? They talk about professional 50 lakhs rule is there. What is the rule? 50 lakhs rule. Right? If your gross receipts exceed 50 lakhs, then you have to do tax audit. Exact 50 lakhs, do tax audit. Less than 50 lakhs, no need to do tax audit. But suppose only cash receipts or cash payments are just 5% of the total, just 5% of the total, then definitely remember this, 5% of the total. Then please remember that this 50 lakhs limit is increased to 75 lakhs. That means less than these limits, do tax audit. Oh, no need to do tax audit. Less than this limits, if your turnover is, don't do tax audit. More than these limits, do tax audit. Correct? And finally, I want to tell you, if you are filing return under 44AE, 44BB, 44BBB, 44ADA, and then you say that my income is less than the percentages specified in these sections. then obviously you are supposed to maintain books of accounts under 44AA, but also get the tax audit done. Okay, clear. Now, who should do the tax audit? Obviously, a chartered accountant should do, right? Cost accountants are fighting for the same, but as of now, we have still to get that good news, right? So, only chartered accountants till today. Now, when you should submit the tax audit report? At least 1 month before filing the income tax returns. Suppose you are a assessee in international transactions, then 30th November of the assessment year is the due date for filing returns. So in that case, tax audit report should be submitted by 31st October. But suppose you are an assessee not covered under international transactions, not required to give report under 92E, then you have to file returns till 31st October, right? Then in that case, you have to submit your tax audit report before 30th September. On 30th September is also okay. But suppose if you don't submit the tax audit report on time, then what will happen? Obviously, penalty. How much penalty? Penalty is 0.5% of the turnover. How much penalty? 0.5%. 0.5%. Suppose your turnover is, let's assume, 1 crore. Then 0.5% will be 1 crore. 1 crore, 1% is 1 lakh. So 0.5% is 50,000 rupees. Okay? Right. Simply remember this. So 0.5%, not even 1%. Half of 1%, that is 0.5%, 0.5% of your turnover, or rupees 1,50,000, whichever is lower, right? 0.5% of turnover or rupees 1,50,000, whichever is lower, that penalty you have to pay. If you don't get the tax audit done by a chartered accountant and or you submit the report by at least 1 month before filing income tax return. If you fail, these penalties will be applicable. Right? Now, we completed these two sections, 44AA, 44AB, the most important part of this lecture. Now, some miscellaneous concepts are there. We'll quickly complete it. Right? Exam wise, less important, but still, let us understand. 4145A section we are discussing. Right? We are talking about maintenance of books of accounts. Now, if I ask you what is books of accounts, you will tell books of accounts are books of accounts. It may be journal, it may be ledger, it can be account books or other books. Like that, you can say, no problem. But you should maintain books of accounts, right? And in that, you have to value the inventory also. So, how to value the inventory? Obviously, your inventory should be valued on cost basis or net realizable basis, whichever is lower. Now, when I wrote inter exams, on this 4 marks question came. They gave a simple table, compute the value of the inventory. Right? They gave the question like this. Then they said nature of inventory. Then they said A, B, C, D. Then they gave cost for ABCD and similarly they gave net realizable value for ABC. What a simple question to solve. Lifetime jackpot, which mostly we don't expect in exam. But I got it. I'm thankful. So suppose if you get the same, what will you do? For category A, separate, right? What is the value? Cost or net realizable value, whichever is lower. For category B, cost or net realizable value, whichever is lower. Category C, cost or net realizable value, whichever is lower. For category D, like that, you should be able to compute separately, then your answer will go right. Next, suppose if on the inventory there is something called as tax, duty or any cess, then add to the cost, right? What's special in it? We have to add it to the cost. But when you see these lines actually, you will see goods are there, services are there. Now, obviously, please understand, in relation to goods, there will be some service or not. Suppose you are actually purchasing some jewelry. So on jewelry, there will be some service, right? Like installation, jewelry, there is no installation, but designing will be there. Suppose you purchase an AC, then installation service will be there, right? Transportation service will be there. That's why they use service as a word here. Okay. So in relation to that, if there is any tax duty or such, add to the cost. This is point number 2. Now come to third point, fourth point, and fifth point. They all talk about securities. Now, if securities are not listed on the stock exchange, right? And suppose even if it is listed on the stock exchange, they are not quoted. That means they are not shown on the stock exchange on a regular basis, right? So if you have securities which are not listed on the stock exchange, maybe a private limited company, maybe a one-person company shares, like that we are talking about, or some company which is listed but not traded much, right? In that case, we call them as unquoted shares, right? If these two type of companies are there, right, unlisted or listed but unquoted, then whatever initial value of the securities, you take that value as the value of the securities. That's it. But suppose if you have any other securities, then cost or net realizable value, whichever is lower, is the value of that security. Right? Now, I'll tell you one thing. If suppose shares are listed on the stock exchange, then whatever the price is shown on the stock exchange, that will be the value, no doubt. If it is unlisted, unquoted shares or securities, like example, equity oriented mutual funds are there, right? Units of business trust are there. These are also traded now. So that's why I am telling that if it is listed and quoted, take that value which is there on the stock exchange. Not listed, or if listed but not quoted, then take initial value at which it is written. But if it is other securities like debentures are there, deposit certificates are there, then cost or net realizable value, whichever is lower, should be the value. Right? Suppose if it is a case of bank or public financial institutions, then obviously you have to value the securities here also. Like HDFC Securities hold the securities, like Life Insurance Corporation also holds some securities. So what should be the value taken? The value should be taken as per ICDS. Okay? But think that because it is a bank or public financial institution, there are some extant guidelines issued by the Reserve Bank of India. Extant guidelines issued by RBI. And if extant guidelines are issued by RBI, you have to follow that. Extant guidelines are issued by RBI, you have to follow that. Then ICDS. Okay. Now, please remember, whatever I am talking now is only for the purpose of income tax. Right? You don't apply this logic in your accounting textbooks. Right? Don't apply these logics in costing. Costing has a separate logic which costing teacher will teach. Accounting has separate logic which accounting teacher will teach. Income tax has a separate logic which I am teaching to you. Follow this. Okay. Now, what I want to tell finally, that whenever we talk about securities to be valued, it has to be valued category wise. So there are different nature of securities, correct? So each nature of security is a different category. So accordingly, you value the securities. Don't mix all in one bucket. You cannot. Every security is different, right? So all similar type of securities come in one bucket, that is category. Another group of securities come in a same bucket, that is category 2. Like that, category wise you should do valuation. Okay, great. This you understood. Now let's come to the final section of today's class, that is under section 145B. They are talking about determination of income. Till now we discussed about valuation of inventory, whether it is goods or securities we completed under 145A. 145B talks about income determination. Here they gave about interest on compulsory acquisition, or sometimes what you do is you get enhanced compensation. So for the delay which the government do in paying the money, they also pay you interest. So how to value that is the challenge. Remember a simple golden principle, that interest is only taxable when it is received. So interest on enhanced compensation or initial compensation on the compulsory acquisition by the government, right? That is taxable, but only in the year of receipt, right? Taxable only in the year of receipt. And that too, not under PGBP, it is taxable under income from other sources. So that will be taxable on income from other sources head, under the head income from other sources. Clear to all of you? So any interest on initial compensation, any interest on enhanced compensation which you receive during compulsory acquisition by the government of your property, that is taxable, but on receipt under the head income from other sources. That too, government says 50% standard deduction we are ready to give. Suppose you receive 1 lakh interest, deduct 50,000 directly, 50% of it, 1 lakh into 50%, 50,000. So how much is left? 1 lakh is the interest received, 50,000 is standard deduction, balance 50,000 is tax. That's it. Now, we are talking about export incentives. So export incentives government gives actually, correct? Export incentives government only give it to you. So in that case, if government declared that they are going to give you incentives, so receiving that incentives is almost certain now. In that case, treat it as income. Okay, right. Then we have to discuss the last one, and that we are talking about subsidy. Generally, what will happen if you get the subsidy relating to fixed assets, then it would be reduced from the cost. Okay, but other subsidies where it is nowhere connected with fixed assets, it will be treated as income, but only when you receive it. So subsidy treated as income, right? If it is not in relation to fixed assets, it will be treated as income in the year of receipt. So like this, you should understand the entire concept which I tried to explain. Now we'll do 44AD, 44AE in the next video. Till then, take care. Bye everybody.